Many have begun to speculate that the sheer amount of debt is no longer something that can be swept under the rug. This is particularly evident with corporate debt at record highs and the surging defaults becoming more and more apparent. This can't end well, even though we are told that the Fed will save the day. But I guess they really helped us out in 2008, right? You came here for the truth, so let me unveil that for you. Today we are going to talk about corporate debt. We're going to talk about margin. We are going to talk about the stock market. I want to look at various issues dealing with the financial system. Let's begin by taking a look at this article out of CNBC. The biggest red flag for the next recession: corporate debt to cash ratios are possibly the catalyst. And I wanted to cover this today and get into some detail. The roots of the next recession could lie in U.S. corporate debt to cash ratios, according to a top U.S. economist. The cash to debt ratio of speculative grade borrowers reached a record low of 12% in 2017, below the 14% in 2008, meaning that for every dollar they have in cash, they have $8 of debt. Corporations are borrowing against their net worth as opposed to borrowing against cash flow and income, which is effectively what households were doing in 2004, 5, and 6. This is a problem that is being swept under the rug, and as I suggest in the introduction, they can't do this anymore. U.S. corporate debt has reached a record $6.3 trillion, and that was back in June of 2018. Many companies have been borrowing greater amounts at extremely low interest rates without effectively improving their liquidity profiles. And when you do that, you eventually run into a brick wall. And when that happens, we have to realize what the results will be. The IMF has highlighted this as a threat, warning that riskier lending behavior could lead to another crash. They do so very frequently, and of course these warnings go unnoticed, and that's just the way it is. This article here out of Bloomberg talking about more people worrying about the U.S. non-financial corporate debt, which is at an all-time high as a share of the economy. They're looking into this detail further. I'm not going to get into all the issues. If you really want to read it, you can do so. I'll have a link in the description. The Fed is starting to watch the leveraged loan market carefully as these loans proliferate. Bank of America is on recession watch, modeling losses from a junk bond crash. Bloomberg goes into the details more on that if you're interested. They try to whitewash it in many cases when you look at the mainstream news, but simply look at the numbers. I will show you the charts on that, of course. Take a look at this. Corporate debt has increased by over $2.5 trillion or 40% since its high in 2008. That should be worrisome to anybody who is paying attention, because the issues are never going to be the exact same every single time. It can come from subprime, it can come from tech, it can come from left field, it can come from right. We never know where and when. However, we can point to the different extreme risk scenarios and be able to understand where the possibilities lie. We're looking at 40% greater in this particular instance right now. All along this whole period of time, we've got record low interest rates. The U.S. has never done this kind of thing before, and people have been borrowing. Corporations have been borrowing. We have seen risk-taking go to the highest it's ever been, and yet it's just being covered up by this sense of safety and security and regulations and everything that is really only there to blind you from the truth. U.S. corporate debt outstanding as a percentage of the GDP, and it seems like that number, 45%, is very consistent. The last two times it was approaching that 45% mark. Previous to that it was about 43%, and now we're at a record high. You're looking at this right now. It just happens to coincide with a recession every single time. Will that be the case this time around? You tell me. But it just seems a little bit too convenient, too coincidental that this is yet another period of time where you have the corporate debt to GDP, and it's just very interesting to see how these are all lining up right now, particularly in 2018. Japanese bank Nomura said in a research note in early November, for the first 10 months of the year, defaults on Chinese offshore corporate dollar bonds, OCDB, total $3 billion compared with none last year. It expects more defaults to come over the next 2 years. Gets into more details on that in the CNBC article. But here, I think the government needs to be very mindful of some of these potential links, but says that, there's no systemic risk, don't worry about it. At the very bottom, they get into further detail. Nomura said that the outstanding dollar-denominated Chinese corporate debt stood at about $751 billion in the third quarter. That's more than double the amount at the end of 2015. This is rapidly increasing. You have the defaults increasing, and of course that's going to cause a problem. Whether or not that's going to be the issue, I don't know, but it seems to be yet another pin that's being pulled out and could potentially lead to a crisis. It's not good when you have so many things lined up and so many potential risks. It's not just one. In 2000, what they were looking at was tech. Everybody was looking at tech saying, that's going to be the issue. That's going to pop at some point. That's going to pop at some point. They weren't really looking around. They weren't really suggesting that there could be this issue or that issue. Everybody was pointing to tech. Today, it can come from basically any avenue. Margin debt and free cash balances, you can see this right here, is insane, at the most insane levels, and we have never seen anything close to this today. Net credit balance, all right, so when you're looking at this, you have to see on the left hand side, when we look at this, it's actually in the negative. You can see the red on the far right corner. Let me highlight that for you. This basically just shows us the sheer amount of debt that is experienced right now. The sheer amount, the margin balances and the free cash balances going into the negative at such an extreme rate here. Margin debt levels have accelerated to a record that we have never seen before. It's far, far beyond anything. And I hope that the chart makes itself clear if I haven't been for you, but it's just so telling, truly is. Free cash balance versus the S&P 500. So another way to look at this, and by the way, this is inverted. The net credit balance in the red is inverted to then correspond to the S&P 500. And what people have done, they have expanded their margin. They have expanded the use of debt, the use of all of these different derivative products, all of these different methods that they can use a small amount of cash and make it seem like they have much, much more. Margin is going to be one of the biggest problems that we will experience. There's no doubt about that. Whether it's the catalyst, I don't know, but certainly it's going to cause a huge problem for a lot of people. And you could see that what has occurred right here. It's very clear to me. I hope it is to you as well. This I found interesting, just something correlated with this. When you look at what the Federal Reserve has done, what all of the central banks have done, and that has been to completely and entirely annihilate what was normal and cause a complete dislocation of the system that was in place before. As of the financial crisis, this has been completely out of whack. Anyway, look at the flash crash risk, abnormal LIBOR and the Euribor spread. For those who don't know what the Euribor is, in the LIBOR, I'm sure everybody knows by now, but the Euribor is short for the Euro Interbank Offered Rate. Their rates are based on the average interest rate at which a large panel of European banks borrow funds from one another. Okay, that's just it. And take a look at this. It happens to coincide with 2008. It happens to coincide with 2000. How many times does this have to line up? There are so many things that have gotten back to the same levels, or in fact become much worse than they were in 2008, in 2000, and beyond. Then we look at this. The complete opposite end of the spectrum. It seems that there are some people, a small group of people, who have more money, more wealth, more power, more control than ever before. Christie's tops Sotheby's in Monster Week for auction sales. Listen, doesn't matter who topped who. There's $2 billion worth in the past week. $2 billion. I don't understand the amount that people are spending on these. And I know that a lot of people say that, they're doing this so then they could secretly be moving money around, transferring wealth. It's a good way to do that. That's besides the point. What I see here is people who have money to spend. All right. Things have certainly changed. In the last 10 years, we've gotten completely out of whack. You can thank your central bank for that. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And last but not least, if you found this video informative, well, I know you're going to find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can flip through these books at Amazon. There's a link in the description below. It's going to tell you everything you need to know. You can flip through the pages to see those details. And if you want the audiobook instead, that's at themoneygps.com.